Bitcoin is trading around $80,600 as we speak, down nearly 1% in the last day, and yet the chief investment officer of Bitwise, Matt Hougan, has just reiterated a forecast that trillions of dollars will pour into this asset over the next decade. That is not a typo. We are talking about a potential price target of $1.3 million per coin by 2035. So why is a leading institutional voice doubling down while the market is drifting sideways? The answer tells us everything about where smart money is actually looking, and it is not at the daily price chart. Hougan frames it bluntly: the risky bet today is not owning Bitcoin at all, because the infrastructure for institutional entry is finally complete, and the capital waiting to move is measured in the hundreds of trillions. The catalyst that Hougan keeps returning to is asset tokenization, the process of issuing real-world assets like bonds, real estate, or private equity directly onto a blockchain. In a recent interview, he stated this could unlock trillions of dollars in value by making previously illiquid assets tradable around the clock. This matters for Bitcoin because tokenized assets need a settlement layer and a store of value, and Bitcoin is increasingly playing that role in institutional portfolios. You can see the shift already. Financial advisors managing an estimated $175 trillion globally are now actively exploring crypto sectors beyond just spot Bitcoin ETFs. The question is no longer whether institutions will enter, but which gateways they will use, and Hougan believes on-chain finance will pull the entire crypto market, and Bitcoin with it, into the world's mainstream financial plumbing. Perhaps the most startling data point from Bitwise research is the swing in recommended allocation. Just a few years ago, a 1% crypto weighting was considered aggressive. Now Hougan talks about a 40% allocation as the rational endpoint for long-term institutional investors. How do you go from a token gesture to nearly half a portfolio? Because the risk-return profile has flipped. With government bond yields being eroded by inflation and equity markets looking fully valued, a verifiably scarce digital asset that grows its network effect at 30% a year looks like an asymmetric bet. Hougan is not speculating blindly, he is observing that the custody, regulatory and liquidity infrastructure now exists for pension funds and sovereign wealth funds to allocate meaningfully. The recent record inflows into spot Bitcoin ETFs in the fourth quarter of last year prove that the pipe is not just built, it is being used. If trillions do start flowing as Hougan predicts, the Bitcoin market would look unrecognizable. At current prices, $1 trillion of new investment would absorb more than the entire market capitalization of Bitcoin today. But Hougan's model accounts for growth, envisaging a 30% compound annual growth rate over 10 years, which gets you to that $1.3 million area. The implication is that Bitcoin gradually transforms from a niche inflation hedge into a global reserve asset sitting alongside gold. The key near-term signal will be how quickly tokenized funds gain traction and whether central banks begin to hold exposure indirectly through sanctioned funds. With the Bank for International Settlements now running tokenization pilots, the direction of travel is set. Today's $80,000 price is just the quiet before a very large wave. So what do you do with this information today, on the 8th of August 2026? The takeaway is not to blindly buy a dip, but to recognize that the risk framework for crypto has fundamentally changed. The story is no longer about tech enthusiasts and early adopters, it is about pension liabilities, insurance float and sovereign reserve seeking a new layer of the financial system. Hougan's thesis strips away the noise and focuses on the plumbing. If you want to position yourself, pay attention to the regulatory signals coming from the UK's Financial Conduct Authority and the European Union's Digital Asset Framework, because those will dictate the pace of tokenized fund authorization. The trillions are not here yet, but the anchors are being laid, and missing that shift is now the institutional risk. The real danger is not Bitcoin falling to $70,000, it is being left out of the largest reallocation of capital in a generation.